Hello and welcome. Thank you for watching a preview of Eide Bailly's CECL solution. Eide Bailly is a top 25 CPA firm in the nation and has been servicing financial institutions for more than 70 years. Our financial institution clients range in size from $10 million to more than $8 billion in total assets. Today, Eide Bailly has 33 offices in 14 states, and we serve financial institution clients in more than 20 states. In June of 2016, FASB issued Accounting Standards Update 2016-13, Financial Instruments Credit Losses, which revamps the allowance for loan losses methodology. The new standard requires a new methodology referred to as the Current Expected Credit Loss Model, or CECL. This is a change from the existing methodology, commonly referred to as the Incurred Loss Model. The new CECL standard says that the allowance for credit losses may be determined using various methods. For example, an entity may use discounted cash flows methods, loss rate methods, roll rate methods, probability of default methods, or methods that utilize an aging schedule. Eide Bailly's CECL solution provides your financial institution with a spreadsheet-based model that utilizes the vintage analysis methodology, which is an acceptable loss rate method in the new Accounting Standards Codification, Topic 326. Let's take a look at the Eide Bailly CECL solution model now. The Eide Bailly CECL solution model has several tabs containing various loan loss calculations that summarize onto the Page Summary tab. Here is where the model produces the required amount for your allowance for credit losses. The total of the allowance for credit losses is comprised of two primary components: loans analyzed individually and loans analyzed by common risk pools. The common risk pools of loans is where the vintage analysis is applied. The calculation exists on the blue tabs for each loan pool your institution has decided to create. Bank regulators have said that it would be allowable in certain situations to utilize call report loan codes as your loan pools. However, it is recommended that your loan pools under CECL be analyzed at a more detailed level, separating loans into common risk pools. Eide Bailly's CECL model is completely customizable to whatever loan pools you have created. Our example here has determined common risk pools of loans to be Ready Reserve, Ag Equipment, 3-year and 5-year terms, and Commercial Real Estate, 7 and 10-year terms. Let's take a look at the 3-year Ag Equipment Pool tab. Here is where the bare bones of the calculation exists. Loan data is entered into the orange highlighted cells below the data tables, which feeds into the loan loss analysis by vintage year above. The loss history requires minimal data points, the original loan balance by year, and subsequent loan losses and recoveries. The calculation then estimates the remaining expected losses based on the current loan balance and the remaining loan life. ASC 326-20 says that the entity shall estimate expected credit losses over the contractual term of the loan, but should also consider prepayments. The vintage analysis methodology inherently considers prepayments, because this method looks at lifetime loss history by origination year. The calculated lifetime loss percentage is adjusted by qualitative factors that consider current conditions and reasonable and supportable forecasts. Eide Bailly's CECL solution provides financial institutions with tools to support their conclusions about factors regarding current conditions and forecasted economic conditions by determining whether certain economic indicators are trending negatively or positively. These economic indicators can be obtained by clicking on one of the website links provided, which are completely customizable for your institution's geographic location and applicable economic indicators. The total reserve for each loan pool flows back to the Page Summary tab. You may add additional loan tabs by simply unhiding one of the many pre-formatted tabs, and also by unhiding the corresponding row on the Page Summary tab. Just enter the loan risk classification name at the top of the new tab, and bam! You are ready for your next loan pool. Eide-Bailly's CECL model also includes an optional area to apply allowance factors from tested loan pools to untested loan pools. By untested loan pools, we mean pools of loans for which historical loan losses and qualitative factors have not been analyzed. ASC 326-20-55-3 says that when determining historical loss information and estimating expected credit losses, the information about historical credit losses should be applied to pools that are defined in a manner that is consistent with the pools for which the historical credit loss experience was observed. This implies that you may apply the loss factor, adjusted for current conditions and reasonable and supportable forecasts, to other loan pools that have the same credit risk characteristics as the pool for which the loss history was observed. The untested pool is an optional feature of our solution, but does provide a practical expedient to institutions that may have smaller or insignificant loan pools that may have insufficient data to effectively analyze loss history. Changing periods in the Eide-Bailly CECL solution model is also a breeze. Just change the date on the Page Summary tab, and all of the tabs within the worksheet are automatically rolled forward. The Eide-Bailly CECL solution spreadsheet also contains tools to analyze loans individually that may either be considered impaired under the new definition, or is a loan that does not fit into one of the other risk pools. In addition, the Eide-Bailly CECL solution model has a tool to calculate loan losses for open-ended lines of credit. We feel the Eide-Bailly CECL solution is the right choice for your institution because, being a spreadsheet-based model, it is easy to use, but at the same time has robust functionality to support complex loan portfolios with many risk pools. It has built-in security features to prevent unwanted formula changes. The model requires minimal data points to gather and is easy to implement. For pricing and information regarding Eide-Bailly's CECL solution model, please contact your Eide-Bailly Financial Institutions representative, or contact Gary Smith at 303-586-8510 or Tom Fogarty at 605-367-6719. Thank you again for watching a preview of Eide Bailey's CECL solution.